Hello everyone, welcome to Property Experts, where we provide you information related to property in a sensible manner. Hence, before purchasing property worth lakhs and crores of rupees, please do watch our videos to never fall in any sort of a scam or a fraud. Well, real estate is a favorite investment topic both for the resident Indians as well as the NRI community. A late lot of changes has happened in the real estate space. Enactment of rare laws, changes into the tax laws and several other things make real estate a topic to study. We bring to you all the things that are happening on the ground in the real estate space. Well, in the last video we have told you about the RERA law, and I just want to inform that the property buying in by the NRIs, is it the same for the resident, where a different process for all of these is taking place? We'll see. If you look at it, you will know that the regulations viewpoint, bearing a few precautions to be taken, is virtually the same now. What are the precautions that you have to take when you are an NRI purchaser? You cannot buy certain types of properties. You are free to buy residential, commercial and developed plots, but you are not allowed as per the RBI laws to buy agricultural and farmhouse or plantations. The second precaution you have to take is if you want to repatriate your money whenever you sell that property, then you better invest that property from inward remittances through either your NRE account or NRO account. And if you are investing through the local funds, then you can still repatriate your money, but it will be under a different scheme. You said that NRIs cannot buy specific types of properties, the agricultural land, farmhouse and other things, but before they buy the property, will the buyers, the seller, inform them whether this is something which is available for NRIs or it is not available for NRIs? How will they know what is that they can buy or what is that they cannot buy? See, builders at times do not inform because they may not be aware of that person. The office is dealing with the NRI, so it's up to the NRI to take those precautions and consult an advocate to guide them to buy the right kind of properties. When NRIs buy property, they obviously will be taking loans. Will the loans be made available for NRIs to buy property in India? If yes, what is the process which is involved? If there are restrictions, what are the kind of restrictions that are there? See, many a times our NRIs live outside of India. They cannot come here to buy and sign the papers and do all the paperwork. Is there a way sitting in some other country that they can still buy properties and go ahead with the paperwork? See, there are a couple of questions merged into one. I'll break them into different issues. So, as for number one, the NRI who is not able to come to India to buy the property should execute a power of attorney in fear of a relation, preferably, and that power of attorney should be a registered power of attorney. When we say registered, means you have to execute in front of the registrar of stamps in a particular city or a district, and to see that the specific purpose of attorney of money is given to only buy the properties, because we have instances where powers and has been misused. So these precautions should be taken. So one word of caution for NRIs is you have to be very careful when you give power of attorney. Power of attorney should be specific, the purpose of buying the property, and it should be ensured that it cannot be misutilized for some other purpose. Now somebody may have a doubt that if I can come to India to register a POE, I can as well come to India to buy the property and register in the surname, and you don't have to come to India to register. Oh, POA can be signed before the embassy. It can be sent back to India in India. There's a procedure called adjudication of the POA signed in the foreign country, and the adjudication process is very simple. The sub-registrar adjudicates it, and it takes only minimum 1 to 2 days to get the document back, and the cost is also very low. I think the total stamp duty including penalties and all is only 1,000. As for me, 1,000 or like 2,000 rupees. So you need not come to India to register a POA. Okay, but how can they avail loan in India to buy the property if they are staying outside? Outside India. What is the process involved here? Now, to avail a loan, let us understand there are no restrictions on how many houses you can avail a loan, being an NRI or being a resident Indian. There are no restrictions. You can avail a housing loan on multiple houses at the same time, provided you have sufficient income to service all your loans. So that there's point one, and number point is banks will ask for certain documents to verify your status as an NRI, be your income, that is your job visa, your passport copy or your salary slip, your bank account in the country where you are staying and working, plus your bank account within the country, and they will need one guarantor within India, so that the guarantor can be a relation or can be of a family member. No documents are asked from the guarantor. He has to only sign as a guarantor and should be the known person to you and say guarantee. It's not a personal guarantee, it's a guarantor for the loan or for the loans coming in India, because for a simple reason, if tomorrow you default, cannot pay the loan, and you are residing in some foreign country, then how is the bank going to recover your money? Now it has to become an international issue. So you have to go to the embassy. There has to be an agreement between the country where you can go and get the money back. So for those purposes, a local guarantor has to sign the documents. Again, the bank also would ask to execute the POA if you are not coming to India to sign the loan agreement with the bank. So, okay, then it can be executed abroad. You did not come to India. So the same process has to be followed. The bank will also have its own draft for the POA based on that draft. You have to take a print out there, sign it before the embassy and send it back to India for its education. So to that extent, it is pretty simple. It is only the question of finding a guarantor, and that's one question that you always have. A family member has to stand by. Fine, now the NRI by the property, now with the intention of coming back and staying there as a need based of property, they could be buying this property with an intention of investment purpose only. It will sell it for consideration higher than what I have purchased a few years down the line. A couple of decades down the line, once buying the property, are there any restrictions for the NRIs to sell this property, or they can simply sell it whenever they want and they can repatriate their money? What's the process involved in this? There are no restrictions on selling the property by NRIs, but the NRIs has to wait for a minimum period of 2 years from the date of the sale date, which is registered in his favor, and the possession of the property is handed over to him or her. Because if he waits for 2 years, thereafter he says that the tax liability is less, because then you fail under the long-term capital gains tax bracket. But if you sell within 2 years, then you have to pay the regular income or the income tax, which is on a higher side. So that is one thing that the timing has to be taken care of. The second aspect is, if you are going to occupy your property, you can rent it out, as there are no restrictions in the renting out of your property, and you are allowed to repatriate the rental money also. There is no restriction on repatriation rental money. Only thing is that the rent amount has to be directly deposited in the NRO account. You have to just give instructions to your tenant to directly deposit the amount in NRO account rather than in a local savings bank account. The repatriation is very easy. When they have to repatriate the money, the NRO account probably have to shift his money from NRO account to one NRE account. Probably a chartered accountant certificate could be required for filling the tax returns. Here, because it becomes the resident income of a course. Now let us understand, when you are selling the property, there is a different tax implication. When you are renting out the property, there is a different tax implication. When you are renting out the property, the rent income is considered to income earned in India. For that, if your rental income is exceeding the minimum taxable limit within India, then you have to file a return of income tax for those years. Whenever your return income exceeds the minimum tax amount, now for that you have to hire a chartered accountant services, and it's a simple income tax return that can be uploaded by when you are selling the property. That time there are many more precautions you have to take. Like when you are selling the property, you have to be selling a property to the resident Indian, or you may be selling the property to a non-resident Indian. The implications are different. If you are selling the property to a resident Indian, the resident Indian will deduct a TDS of only 7 to 5%. That's for the resident India, unless you sell it to a resident which is Indian and it is outside India. Indian TDS applicable is 0.7. The way it is looked at it, there are different sections. One is section 194(1)(a). Now section 194(1) is applicable only between resident Indian and resident Indian, which is 0.75%. But if it is an NRI and a Indian resident, then Indian resident has to deduct tax based on the nature of your property, whether it is a long term, which is more than 2 years, or it is a short term, which is less than 2 years. You mean to say the responsibility shift to the buyer, to the property of the buyer of the property, because he has to deduct the TDS, right? NRI is selling the property to a resident Indian. How much of TDS he has to deduct depends on the type of property and whether the person who is selling the property is selling it after 2 years or not, the type of property, but the period of your holding. So you have to give him the details of your original purchase document. He can come to a clear understanding whether you are eligible for long-term capital gains or for a short-term capital gains. Now if it's a short-term capital gains, the tax rate is straight away 30%, which the purchaser will deduct from your sale price. If an NRI sells the property for 1 crore and this property was purchased just a year before the purchaser, the buyer, who is a resident Indian, will deduct 30 lakhs as the TDS amount and pays to the government. Now because you have put a valuation to the property, I'll come to that question later. The amount, because your income levels are higher, there's something called surcharge, and there's an education even says that So value of your property is below 50 lakhs. There is no surcharge applicable. If the value of the property is between 50 lakhs to 1 crore, 10% surcharge is there. If it is like 1 crore to 2 crores, then it is 15% surcharge. 2 crores to 5 crores, 25%. Above 5 crores, 30% surcharge. On top of the tax plus surcharge, there is a 4% education cess, which also has to be added. Put it on a simple terms, if it's 1 crore property, you will be falling into the 50 lakhs to 1 crore surcharge bracket. That is 10, or your tax liability is 30 because it's within 2 years. 10% surcharge is another 3%, where is 33%, and 4% education says on 33% is again 1 point. To some percentage will almost become 34.2% if the value is 1 crore of your sale price. The buyer, when he buys the property, he does a TDS on the transaction value. It has nothing to do with everything. Actual profits made or losses made, okay. If the buyer or the NRI he is not made any profits, he need to file the tax returns and make a claim back on the NRI who is a seller. There is an option given under the Income Tax Act. He can approach through the chartered accountant, the income tax department, and file an application for getting a certificate issued to the extent of tax to be deducted by the buyer. The officer will be asking for all your documents, when you will be buying and what is the price that you have bought. You made the payment and so and hence and forth. The tax officer will assess what will be your income tax liability. He will issue a certificate saying this is the amount that the buyer should deduct. The procedure takes almost 1 to 2 months time. If you're planning in advance, you know now applying to the department, then the buyer may have to deduct the actual tax liability amount as TDS rather than a very high rate which has been prescribed under the law. To summarize, if all NRIs are planning to sell their properties, it makes sense for them to plan it in advance. Approach your chartered accountants, make your case, get certificate from income tax department. How much could be your tax liability? Once you have this, if you proceed with the sale proceeds, then it becomes easier for you to get less of TDS and less of headaches than to go outright sell and a big chunk of money getting deducted as TDS. I'll give you an example. If you're selling a developed plot which you bought say for 5 years back or 7 years back, now if a developed plot is sold and if it is an old plot, if you don't take the benefit of indexation for arriving at the current market prices for the Income Tax Act, then you are allowed to straight away say 10% as tax liability of the sale value. But if you are selling that plot and you are an NRI and the value of the plot is more than 5 crores, because it is a long-term capital gains, your tax rate is 20. Your surcharge is 37 on 20, which is close to 7.5% plus. Your 4% education says all put together it works out too close to 28%. Now your actual tax liability will be 10% plus surcharge plus education. This will be roughly around 13 instead of the buyer should be deducting 28. The difference of 50 odd percent you can only claim back from the income tax department after filling your return and claiming a refund of that amount, and the department may take another year to give that money back. Your money may get blocked as well as for say 2 years. So better to take that little extra trouble to go through your chartered accountant and throw him file an application to get the exact tax determined and ask the buyer to deduct only that much amount. And once the buyer has a certificate from an income tax department, he's also in a position to deduct that exact amount. Let us look at a case scenario wherein some NRIs does not know what he needs to do. If the buyer does not know how much of TDS is to be done, if they miss these steps, who is liable? What is the penalties that will follow? Or what is the cause under the law? Now if TDS is not done rightly, if TDS is collected in less, then what should be have done? What should have been collected? Now will it get resolved? See, the responsibility of deducting payment and depositing as TDS is on the buyer. If NRI is a seller, what buyer really does not matter to him, and the law will fall on the buyer's head and he will be liable to pay TDS with interest and penalty. So there's the NRI's responsibilities are limited, but being aware and asked, following a right system, it always helps. But when NRI himself is a buyer and he has to follow all the steps. Now NRI can be buying a property from a resident Indian or maybe buying from some other NRI. The property is based in India, so he has to follow both the steps. When he is buying a property from a resident Indian, he has to deduct only 0.75%, which is under section 194(1)(a) of the Income Tax Act. He has to deposit by a challenge or like from the income tax treasury account. Whereas if he is buying from an NRI, then he has to deduct the exact tax under section 195 as I have explained earlier with a much higher slab, as he should be aware of both the provisions. Now in the event of the buyer did not do the TDS to required action, but that does not take away the responsibility of an NRI to pay the proper taxes. TDS is a preventive taxation. Ultimately, the tax liability still remains with the person who is selling this particular property. So far, the particular financial year, whatever is the profit earned on the side of profit the property to be a short term gain or to be a long term gain, he has to file his income tax returns and he has to discharge his taxes. Because the buyer has not paid proper TDS, he won't be getting the credit of that. So he has to pay from his pocket the income tax. So all in all, it is fair to say that if the buyer has not done the TDS there is no need for you to celebrate your tax liability. It is still strange you have to file a tax return. And whatever the differential taxes that you have to pay, they are obliged to pay. That particular money or face the law that's right. If you thought buying real estate is very simple, no, it is not that simple. Make your due diligence, research all the things that you need to know. Get insights from the episodes before you sign in. Proceed with this slow and steady process. Thank you so much for watching this video. I hope this video made you a little bit knowledgeable and you came to learn about a lot of things. Do watch all of our videos so that you have no doubts regarding knowledge.